773 workers across Florida and Georgia faced sudden uncertainty in mid-April 2025 when their employer, Consolidated Burger Holdings, filed for bankruptcy protection in the U.S. Bankruptcy Court for the Northern District of Florida. The company had just $179,000 in cash against total debt exceeding $36 million. 57 Burger King locations now faced an uncertain future, including restaurants in Tallahassee, West Palm Beach, Naples, and Valdosta, Georgia. This was not an isolated failure. This bankruptcy represented the continuation of a pattern that has affected hundreds of Burger King locations across the United States. And despite a multi-billion-dollar turnaround effort by the parent company, the franchise system continues to shed operators who cannot keep up with the financial demands of running a Burger King in 2025. Restaurant Brands International reported $2.45 billion in revenue last quarter alone. So the question is not whether Burger King will survive. The real question is whether the franchisee model that has served as the backbone of American fast food is fundamentally broken. The warning signs for Consolidated Burger Holdings appeared long before the bankruptcy filing. Back in 2019, the company filed a lawsuit against Burger King Corporation, alleging that the franchisor had threatened to terminate franchise agreements based on what they described as fabricated remodel defaults, designed to force them out of the system. The two sides reached a settlement in September 2024, but that settlement failed to address the underlying problem. Burger King had launched an aggressive modernization program called Reclaim the Flame back in 2022, requiring franchisees to upgrade their restaurants with new technology, kitchen equipment, and building enhancements, with a goal of reaching 85% modern image by 2028. For well-capitalized operators, this modernization push represented an opportunity because remodeled stores were generating sales uplifts in the teens and averaging around $2 million annually. For Consolidated Burger Holdings, it became a death sentence. On February 20th, 2025, Burger King Corporation declared defaults on all of Consolidated's franchise agreements, citing failure to complete the required remodels. Burger King agreed to temporarily hold off on enforcement until April 14th, which turned out to be the exact day Consolidated filed for bankruptcy. The financial trajectory tells the story of a slow-motion collapse. In fiscal year 2023, Consolidated Burger Holdings generated $76.6 million in revenue, while losing $6.3 million. By fiscal year 2024, revenue had dropped to $67 million, and the operating loss had nearly doubled to $12.5 million. When you divide that $67 million across 57 restaurants, each location averaged just $1.17 million in annual revenue, nearly 30% below the Burger King system average of $1.6 million. The company had attempted to find a buyer before resorting to bankruptcy. Starting in July 2024, they engaged Peak Franchise Capital to market the assets, contacting 235 potential buyers over 7 months, while 32 parties conducted due diligence. Not a single one presented an executable deal. By the time of the bankruptcy filing, Consolidated owed $14 million in secured debt to Auxiliary Capital Partners, another $21 million in unsecured obligations, and $2.4 million in unpaid franchise fees to Burger King Corporation. CKJ Burger, LLC emerged as the stalking horse bidder, and the sale closed in June 2025 after Burger King approved the new franchisee as a suitable operator. Some locations were not included in the sale and closed permanently. Understanding how a company with 75 restaurants ends up with less than $200,000 in cash requires examining the convergence of factors that created this financial trap. The court documents point first to the pandemic, saying COVID-19 caused a loss of foot traffic, resulting in declining revenue, without proportionate decreases in rental obligations and debt service. The customers disappeared, but the bills remained constant. Next came cost inflation. Industry-wide expenses increased more than 30% since 2019. Food prices climbed steadily, Labor became more expensive and harder to find, and shipping costs continued rising. Third, the structural economics of Burger King itself created an inherent disadvantage. The average Burger King location generates $1.6 million in annual revenue, while the average McDonald's generates over $4 million. That means Burger King produces less than half the revenue of its main competitor, yet the investment required to open either franchise remains comparable. When costs rise, McDonald's franchisees have a cushion to absorb the impact. Burger King franchisees do not. The effects of these failures cascade outward through local economies. When a franchisee like Consolidated collapses, employees face job uncertainty, suppliers lose a reliable customer, landlords face vacant properties, and the local tax base shrinks. Burger King's official response in April 2025 acknowledged the situation directly, with a spokesperson stating that franchisees who are no longer investing in their restaurants will be exiting the system. The 2025 bankruptcy represented just one chapter in an ongoing transformation of the entire Burger King franchise system. Restaurant Brands International had already spent $1 billion in 2024 to acquire Carroll's Restaurant Group, the largest Burger King franchisee in the United States, with more than 1,000 locations. The plan called for remodeling those restaurants and selling them back to smaller, local operators. By February 2025, Restaurant Brands International, RBI, announced that it was starting refranchising 2 years ahead of schedule because demand from quality operators was there. Chief Financial Officer Sami Siddiqui said the company would refranchise between 50 and 100 Carroll's units in 2025, with more expected in 2026. Results from company-operated stores supported this timeline, with the Carroll's portfolio generating 2.9% same-store sales growth in the second quarter, outperforming the system average of 1.5%. By the third quarter, Carroll's locations reached 4.8% growth. Burger King also launched Crown Your Career, a program designed to transform high-performing restaurant managers into franchise owners over 1 to 3 years. About half of the company's 2025 refranchising came through this initiative. Challenges persisted throughout 2025. Beef prices surged into the high teens % compared with the prior year. And since beef represents about 1/4 of Burger King commodity costs, this created short-term margin pressures for franchisees. Consumer behavior also shifted, and Chief Executive Officer Josh Kobza noted that softer wage households cut spending persistently throughout the year. By the third quarter of 2025, Burger King in the United States posted 3.2% same-store sales growth, its best performance since early 2024. That growth came through focus on the Whopper by You customization platform, and continued investment in store modernization. At the December 2025 Barclays Investor Conference, Chief Financial Officer Siddiqui outlined what comes next. He said 2026 will feature significant simplification of the business model and a return to an asset-light, fully franchised structure. The franchise model that built Burger King over 7 decades is being fundamentally restructured. Large operators with 100 or more stores are being replaced by smaller, geographically concentrated franchisees who live in the communities they serve. The target is now operators with 50 units or fewer. For the 773 workers of Consolidated Burger Holdings, the bankruptcy meant immediate uncertainty. For the broader industry, it signals that the economics of fast food franchising may never return to what they once were. Infrastructure costs keep rising, consumers keep pulling back, and the gap between what Burger King locations earn and what McDonald's locations earn continues to widen. Those who cannot afford to modernize are being shown the exit. The question for 2026 remains whether the operators who survive can withstand whatever comes next.